Okay, good morning. All right, so today we are coming to look at cost volume profit analysis. It is also known as CVP analysis, CVP analysis. And this uh, is a subtopic on short-term decision making, short-term decision taking. So, or decision making rather. And a short-term decision making, we have three topics, subtopics, CVP. We have relevant and irrelevant cost analysis, and we also have contribution and limiting factor analysis. So these three topics, and today we are coming to look at the CVP analysis. So CVP analysis, cost volume profit analysis, as the name suggests, this whole analysis is a concept or is a model that helps us to establish the relationship between um, costs, costs, volume, which is sales, and then profit. Remember, in business, for us to be able to determine our level of profitability or the profit we are making, what we do is to get our sales revenue, then we less the cost from that, and then we get the profit. So at any point in time, these three, there should be a relationship in between them, as especially as a result of what? Change in activity level. So activity level is quantity of production and sales. So what cost volume profit analysis does is that it helps us to determine the relationship between sales, cost, and profit anytime or as a result of change in quantity of production and sales or change in activity level. See, so what we want to know is what will be the change in profit should sales change by a certain quantity, or should uh, production quantity change by a certain, margin. So that is what we will be looking at, the relationship in between these three. So the cost is the usual cost we know. The volume is sales, and then profit is the usual profit you know. So we want to determine the relationship that exists between these three as a result of a change in activity level. All right. Now, before we can undertake this particular analysis, we need to hold some factors constant. So we call them the assumptions. So the assumptions, let's look at them. One, costs are categorized into fixed and variable costs. So before we can undertake CVP analysis, we always have to split our costs into fixed and variable components. Two, analysis takes place within a given period of time, usually in a short run. So for you to do CVP analysis, it should be done within a given period of time. You can't do CVP analysis in perpetuity or in an infinite period of time. It should be a definite period of time, maybe within a 1 quarter, within half a year, within a year at most. You can't go beyond that. So that's why we say it should be within the short run or within the short term. Then CVP analysis applies to a single product, or when you want to apply to multiple products, those multiple products should have a constant sales mix. That means that, for instance, if you are into production of uh, only shoes, then it is easy to do CVP analysis. But assuming you are into production and sale of shoes and also socks, you see, then these two should have a constant sales mix. What does that means is that you see, for me, if you are coming to buy shoes and socks, you have to buy one shoe, 5 socks. That is my sales mix, and it's not something that can be changed. It's constant. So when you come and say you want one shoe, two pair of socks, we will not sell to you. What we do is to give you this constant sales mix. So when that happens, then we can also apply CVP analysis to multiple products. Otherwise, we will only do it for single product. 4, profit is calculated using the marginal costing approach. So you know that in profit ascertainment, we can use two different approaches. We can use the marginal and we can use the absorption. So, but under CVP, we always have to use the marginal. And to use the marginal, you start with your sales, then you less your variable cost, and then you get contribution when you do that. Then you now less your fixed cost, and then you get your net profit. So this is the approach if we want to ascertain profit. In order to use that whole information to undertake CVP analysis, then you must go by the marginal costing approach. Your sales less variable cost to get contribution before you less your fixed cost. Then the 5 says that selling price per unit and variable cost per unit are constant. So under CVP analysis, we hold selling price and variable cost per unit to be constant within the period of the analysis. So you see the reason why we say CVP analysis is done in the short run, because these two are not things you can actually hold constant for a long time. And then the sixth, which is the final but not the least, it says that production equals to sales. So under CVP analysis, there is nothing like opening and closing stock. Whatever we produce, we sell. So at any point in time, production is equal to sales. So when you hear activity level, we are referring to both production quantities and sales quantities because they will be the same. All right, so those are the assumptions. Now let's look at the importance of CVP analysis. The first one is that it helps to determine break-even points of entities. And this helps managers to operate beyond the break-even point in order to make profit. So for every organization that is into manufacturing, you will be making losses if you operate below the break-even point. And you don't make any profit nor loss when you operate at break-even. So you always have to strive to operate beyond the break-even point so that you can start making profit. So you wouldn't even know what you are up to if you don't know your break-even point, because that will push you to operate beyond that in order to make profit. So that's one advantage. The second advantage is that through CVP analysis, entities can forecast activity levels in order to achieve certain profit. So through CVP analysis, we can all right. So through CVP analysis, you can, for instance, estimate the quantity of production or the value of production and sales to do in order to meet a certain targeted profit. And that will help you. So for instance, if you are in business and you want to, this year, your target is to make 1 million profit. Then you see through CVP analysis, you can estimate the number of goods to produce and sell in order to make that profit. And so you focus on that. 3, it helps managers to determine the relationship that exists between sales, cost, and profit at various activity levels. So you can know the relationship between these three: sales, cost, and profit at various activity level, and that is very important. Now, limitations of CVP analysis. 1, mixed cost may be difficult to split into fixed and variable component. So that is a limitation. Then fixed cost, selling price per unit, and variable cost, which we are holding constant, may not be constant over a period of time. They can change. So that's also another limitation. Then when it comes to analysis with multiple products, you have to have a constant sales mix. In practice, is this possible? Can you always insist your customers should buy and mix according to what you want? Sometimes it may not be entirely easy. So that is also what a limitation. Now, for you to undertake CVP analysis, it comes with some formulas. So let's quickly run through these formulas. One, how do you get your profit? You get your profit by deducting your total cost from your total sales. So that is the first model or formula you need to familiarize yourself with. Then the total cost is made up of fixed cost and variable cost. Sometimes we can take the total things away and say cost total cost is equal to fixed cost and variable cost. Or cost is always made up of fixed component and variable component. Then the total variable cost is variable cost per unit multiplied by the activity level. So, but the variable cost, once you get variable cost per unit, anytime you multiply it by activity level, it will give you the total variable cost. Then contribution is total sales minus total variable cost. When you deduct your variable cost from your sales, you get contribution. And contribution per unit is equal to selling price per unit minus variable cost per unit. Or when you have your total contribution and you divide it by activity level, you get contribution per unit. Then break-even point in unit is equal to total fixed cost divided by contribution per unit. Total fixed cost, when you divide it by contribution per unit, you get your break-even point in units. Break-even point in units, we want to know that is the quantity of production and sales in order to break even. So when you are able to produce and sell those units, you will neither make profits nor make loss. So that is the break-even point. So at break-even, total revenue equals to total cost. No profit is made at this point. Profit is made when an organization produces or sells beyond the break-even point. So it is always the target that you have your break-even point and ensure you operate beyond it so that you can make profit. Then losses are therefore made for all activities below the break-even point. So once you are operating below your break-even point, you make losses. Now, break-even point in value, it's total fixed cost divided by CS ratio. When you say CS ratio, it is contribution to sales ratio. And the formula is contribution over sales times 100. So it is here, contribution to sales ratio. Contribution over sales times 100. This is also called CS ratio, you see. And then your break-even point in value, you can also multiply the break-even point in units by selling price per unit. When you do that, you get your break-even point in value. So units to produce in order to achieve a targeted profit. So you have your total fixed cost and then you add your targeted profit to it and divide it by your contribution per unit. You see that? So don't worry, these formulas, once we start solving questions, you get to be familiar with them. You see that? So those are the formulas. I'll send this document to you and then you can look through. So from here, we can start to solve some questions. And I know when we start running through the questions, you'll be fine. All right. Thank you very much. So in my next video, we will start with solving of questions. Thank you. Bye-bye.